Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Blackstone Group, one of the world's largest alternative investment firms specializing in private equity, real estate, hedge funds, and credit. Blackstone has been a significant player in the global financial markets, shaping industries through its investments. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Blackstone Group has been a dominant force in the alternative investment space for decades. From a behavioral finance perspective, how do biases like overconfidence and the anchoring effect influence their decision-making, especially in areas like investment strategy and portfolio management?
Overconfidence is particularly relevant to Blackstone's approach, especially in their investment strategy and portfolio management. Given their track record of successful investments, Blackstone's leadership and investment teams may exhibit a strong belief in their ability to identify and execute profitable deals, even in complex or volatile markets. This overconfidence can drive the firm to pursue ambitious investments with the expectation of high returns, but it also poses risks if they overestimate the potential of certain assets or underestimate market challenges. The anchoring effect also plays a significant role, particularly in how Blackstone evaluates investment opportunities. The firm's past successes and the performance of similar investments can serve as anchors, influencing their assessment of new opportunities. For instance, if a particular real estate market or asset class has performed well in the past, Blackstone might use the historical performance as a benchmark for future investments, potentially leading to a preference for familiar markets or strategies.
And this focus on leveraging their expertise and confidence while anchoring their strategies in past successes has helped Blackstone maintain its leadership position in the alternative investment industry, appealing to both clients and investors who value consistent returns and a proven track record.
Exactly. Blackstone's strategic use of overconfidence in pursuing ambitious investments and the anchoring effect in evaluating opportunities appeals to investors looking for a firm that balances bold strategies with a disciplined approach. However, this approach also means that Blackstone must carefully manage the risks associated with market volatility and changing economic conditions, particularly as the global investment landscape continues to evolve with new opportunities and challenges.
Let's talk about diversity, equity, and inclusion at Blackstone. As a major player in the financial industry, DEI is particularly important for Blackstone. How does this intersect with behavioral finance?
Blackstone's approach to DEI is crucial, especially as the firm operates in a global and highly competitive industry where diverse perspectives can drive better decision-making and innovation. From a behavioral finance perspective, strong DEI initiatives can enhance Blackstone's ability to innovate by fostering a culture that values diversity and inclusion. A commitment to DEI allows Blackstone to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in alternative investments. For investors, Blackstone's focus on DEI can signal that the firm is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Blackstone build stronger relationships with portfolio companies, clients, and communities, reinforcing its brand as one that values inclusivity and ethical leadership.
Investors are increasingly considering DEI when evaluating companies, especially in finance and investments, where the ability to foster inclusivity and adapt to diverse markets is critical to long-term success.
That's right. By embedding DEI into their corporate culture and investment strategies, Blackstone not only improves its ability to serve a broad range of stakeholders but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to global markets, Blackstone operates in numerous countries, providing investment solutions across a wide range of asset classes. How does the firm adapt to different markets, and what role does behavioral finance play in this?
Blackstone's global strategy involves tailoring its investment solutions to meet the specific needs and regulatory requirements of different regions while maintaining its core focus on generating strong returns for investors. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with operating in diverse markets. Blackstone's ability to navigate complex international regulations, such as those related to financial markets, real estate, and corporate governance, allows it to maintain a strong global presence. The firm's approach to understanding local market dynamics and adapting its strategies accordingly helps mitigate risks associated with regulatory changes, economic fluctuations, and cultural differences. By ensuring that its investments are relevant and compliant in different regions, Blackstone can continue to expand its market share and strengthen its global brand.
And this adaptability is essential for Blackstone, especially as they face competition from both local investment firms and other global giants. Their ability to maintain their brand's relevance and leadership in different markets is key to their continued success.
Exactly. Blackstone's focus on understanding local market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the alternative investment industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in global economic conditions, regulatory environments, and competitive pressures.
Now, let's compare Blackstone to other companies in the alternative investment and private equity sectors like KKR, the Carlyle Group, and Apollo Global Management. How do the behavioral finance dynamics differ?
Blackstone's dynamics are often compared to other alternative investment giants like KKR, the Carlyle Group, and Apollo Global Management, particularly in their approach to investment strategy, portfolio management, and competition. Blackstone's strength lies in its diversified investment portfolio and global reach, appealing to investors looking for a firm that balances bold strategies with disciplined execution. KKR, with its focus on private equity and global investments, appeals to investors interested in a firm that emphasizes value creation through active management. The Carlyle Group, known for its leadership in global private equity and asset management, attracts those looking for a firm that combines deep industry expertise with a focus on long-term value. Apollo Global Management, with its expertise in credit and distressed assets, appeals to investors interested in companies that thrive in complex and challenging markets. Blackstone's behavioral finance dynamics are shaped by its reputation for consistent returns, strong global presence, and adaptability, making it an attractive option for those seeking stability and growth in the alternative investment industry.
And unlike Apollo Global Management, which focuses heavily on credit and distressed assets, Blackstone's strength lies in its diversified investment approach across various asset classes, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Blackstone, the focus on diversified investments, global reach, and disciplined execution provides a unique value proposition in the alternative investment industry.
To sum up, Blackstone's approach to business is deeply influenced by behavioral finance principles, whether it's through their investment strategies, global market adaptations, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Blackstone's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.